I'm standing here with Veena Jetty, our partner on this 408 unit multifamily deal here in North Carolina. If you're in your early 20s, or maybe you're just getting into your 30s and you're like, how the heck do I get involved in multifamily? How the heck do I get started in a project, something like this, or maybe something a little bit smaller for the first project? So I'm going to be here to ask all the questions to Veena. Thank you so much for giving us the opportunity to ask these questions to you
Course.
today. The first question I have is like, I maybe just know some stuff about real estate. Maybe I've watched some YouTube videos, but if I want to break into the multifamily space, like what would you say are like the best ways for somebody that's brand new to do that?
Yeah, there's a lot of different ways you can get started. And I think it really depends. What are your goals, right? Do you want to
Okay.
be a purely passive investor? Do you want to be an active investor?
Mm-hmm.
One way you could get started is you could be a passive investor into a fund like you guys have or
Yeah.
one of our funds. And then that's just really mailbox money. Another way you could get started is you could go out and you can source deals. So you can learn how to underwrite deals. You can go out, you can put offers on deals, you can try to acquire deals.
Mm-hmm.
You could also look to be a co-sponsor with somebody. So you could find somebody that would partner with you and you bring maybe the operational skill set or whatever your skill set is that's where I would start when you're trying to get active in real estate.
Okay. Let's imagine I'm 21 years old
Okay.
and I don't have money.
Uh-huh.
I don't know
Well, you don't know
shit
yet.
about
Yeah,
shit.
okay.
But I know that I'll work really hard.
Okay.
I have, a great work ethic. I may be working another job where I'm like, I'm not going to be able to reach my goals and, fulfill my dreams there.
Yeah.
But, where would you say that person should go? If they have a work ethic, like, is there a way that they could reach out to people to be able to partner with and be like, the sweat equity or?
Yeah. So what I always tell everybody, no matter where you are, always start with the underwriting, right? Because
Okay.
the numbers are where every single piece of operating this asset will start and end. And that's where you really understand, is this a good investment? Should we be making a different investment? Should we put money into renovating the interiors? If so, how much should we put in? How much capital do we need? All those questions get answered with underwriting. And if you don't understand the fundamentals of the numbers, you can't acquire the asset, you can't
Right.
operate the asset, and you
Yeah.
can't raise the capital for the asset.
Got
So
it.
I think the underwriting is the best way to start. And there's so many resources to learn how to underwrite a deal. Even if you're not going to be ultimately underwriting the deal, you
Right.
have to understand it and know how to underwrite
So
the
it's
deal.
like understanding like what makes a deal, what could kill a deal. And
Correct.
then you could at least be aware enough that when you
Right.
see a deal, you actually can see a deal.
Yeah.
It's not just, okay, it's for sale, but like what makes this better than the property next door?
That's exactly right. And you can also find an experienced partner and you can bring value that way too, right? So one of the things we'll do on an asset like this, for example, is we'll look at all the comps in the area. So we need someone to call or go and tour the comps
Yeah.
so that we know what they're offering next door and what
Right.
my competition is doing so
Okay.
that we can compete effectively.
Yeah. That makes sense. Now, the property that we're at right now is 408 units. So understandably, if somebody's brand new watching, they're just like, how am I going to be able
Yeah.
to put a deal like that together? So if we go back to maybe like a smaller deal size, like say it's bigger than like a fourplex, triplex, duplex, but maybe it's a little bit like 30 to 100 units.
Okay.
So it's a little bit bigger, but not quite like a large property like this
Yeah.
one. What would you say that would be some ideas of how somebody could maybe source some deals like that for them where they can bring it to somebody that's
Right.
experienced and be able to put a deal together?
So actually, I would say go big or go bigger.
Okay.
So
All
I
right.
don't actually think it being your
Okay.
first deal should stop you from going for a larger asset.
I like that.
But with that being said, you'll need a very strong partner. So
Okay.
there's three major parts to acquiring multifamily assets, right?
Okay.
There's the acquisition where you're going out, you're finding the deal, you're targeting it, you're underwriting it, you're looking at the comps like we talked about,
Right. Okay.
all those different things, that whole acquisition piece. Once you acquire the asset, or you have it under contract, I should say, before you acquire it, you have it under contract.
Yep.
You have to raise the capital.
Okay.
That's usually the easiest part of the puzzle for most new investors to get involved in.
Okay.
So you could do something like a fund of funds on that, or you could have your own fund. Just depends on how you need to or want to structure the deal.
Right.
Then you have the third part, which is the operational part. So that's the execution of the asset once you've acquired it.
Okay.
And all three are major buckets, and you need all three to work. So you can find partners that have the other pieces or bring a small sliver of any one of the pieces. And I will say, if you're coming in on the capital raise side, one important thing to know is there are securities laws and rules that you need to follow strictly. So your first call should be to a securities attorney, making
Okay.
sure that you have everything done legally and
Right.
correctly.
Okay, that makes sense. So looking at those three things, one is understanding like how to underwrite the deal. So then when you have a deal, you can go under contract. Then once you're under contract, being able to raise the money, whether, partnering with other investors
Correct.
to bring those funds in,
Yep.
and then having the strong operational side
Yes.
of like, okay, now we own this property. What the heck
We
are
have
we
to
going to do?
perform,
Now
right,
we need to go and
exactly.
perform and like do the things like
Exactly.
clean it up, paint it, fix it up, right?
And those things will be true whether you're looking at 30 units or 300 or 3,000 units. It's all going to be the same because there are those three buckets. So
Okay.
even if you're looking at smaller deals, those are the three areas you want to really understand who's going to execute on each of those.
Okay. I really like that because, for me, where I haven't done tons of multifamily
Yeah.
deals like this, it was, intimidating before having conversations with you of
Yeah.
like, okay, going to like 200 units, it seems like, oh, we can't start there. But just go big or just go bigger,
bigger,
right?
yes.
It just makes a lot of sense having that conversation with
Well,
you.
and I think that's the thing that deters most new investors is the intimidation of, wait, how am I going to pay for a $15 million asset? I've never done a deal before.
Yeah.
If the deal is good, the money will find you.
Okay. Now, the property that we're at, this is a value add play from the conversations that we've had. So, if we could explain to those that are watching, what the heck is value add? Why is that the strategy that you like to follow? And why is that a good strategy for, new investors to get involved with?
It's one of many strategies. There's a lot of ways to make money, as you know, in real
Yeah.
estate, right? And so we prefer value add because what happens is we can force appreciation, which means we can increase the value of the asset just by making small tweaks to it. So, for example, right, we might come in and we might paint the exterior of this building to
Okay.
bring in more high paying tenants.
Okay.
Well, adding those dollars to our NOI or our net operating income or a bottom line, right?
Right.
Will increase the value of the asset because the way multifamily assets are valued is based on the operating income of the property, the net operating income of the property. And so we have the ability to control the values of our assets, which is one thing I really love about multifamily.
Yes, that makes sense. And because the thing where my world has been in residential,
Right.
where it's like, you're not controlling what the value is going
No.
to be. It's just going to be, what did Susie, the neighbor's property, sell for? What did
Exactly.
John down the street that,
Yep.
had to sell for a rush sell for? And now that's your comp that
Yes.
you have to go off of.
Yes.
When we're looking at the value add side on multifamily, like what are some of like the most basic things that you typically are looking at
Yep.
on a property like this or just any property in general?
We look for any opportunity, whether it's operational efficiency or the ability to renovate the
And when you
unit.
say operational efficiency, what do you mean by
Okay,
that?
so for example, I might be paying $100,000 for a landscaping contract.
Okay.
But once I buy an asset, maybe I'll have 10,000 units in one location and my landscaper will now do it for 85,000. That's an operational efficiency.
Okay.
I didn't have to do anything other than negotiate a contract.
Yeah.
Right? Or maybe I'm taking our property onto a rent management system where I can optimize the efficiency of the rent.
Okay.
That's operational efficiency.
Okay.
Where you can also increase the NOI or force the appreciation is, for example, maybe I put granite countertops in and somebody's going to pay me $75 a month for that.
Okay.
That would be a renovation or a true value add, but
Yeah.
you're adding value through renovation, not just through operational efficiency. And you want to do both, right?
Yeah.
That's the best is when you can take advantage of all the opportunities available.
Yeah. Okay. So Veena, if somebody is very new to this, very green, and they're feeling a little bit intimidated, like what are the first couple steps that they should take from what we've talked about today for them to get their foot in the door and start
Yeah.
moving in the direction of potentially owning a multifamily deal?
Well, I think if they're watching this, you're already well on your way because it is intimidating and it is overwhelming. But the good news is once you get over the first deal and you get past that, it's like getting a monkey off your back.
Yeah.
It becomes so much easier and it's exponentially easier.
Mhm.
What I'll say is multifamily is absolutely the best asset class. And I'm totally biased when I say this, but it's highly scalable, right? You
Yeah.
can have 10 doors or you can have 10,000 doors and it's scalable in a way that single family is not.
Yeah.
It's easier to finance, believe it or not, because they're not underwriting Cody or Veena.
Yeah.
They're underwriting the property and how
Right.
it operates. So it's very easy to finance compared to single family homes. And it has the best risk adjusted return.
Okay.
And it's tax efficient, right?
Yeah.
So there's something called a Sharpe ratio, which determines how much risk you take on for the relative amount of reward.
Okay.
And the higher the Sharpe ratio, the better.
Okay.
And multifamily has historically been the highest Sharpe ratio out of any asset class
Okay.
for decades now. And so that's why I love multifamily and it's tax efficient. So a lot of these assets will give you depreciation. That might be like a whole nother
Yeah,
video,
someone walks in,
but
like, "What?"
yeah, but don't worry, your accountants will know, and they will be so happy when you give them a negative K1,
Yeah.
and you get that benefit even if you're passively investing in real estate as well.
Okay. So I'm new and now I'm like, I'm excited. Veena's talking about this and I want to get my foot in the door. If it was you, what would
Yeah.
you do getting started? If you didn't have any of the resources, any of the relationships and things that you have in your life and
Yeah.
you were just starting from scratch, what
Yeah.
would be like your first step so we can give someone like, at least I could go and do this
Like
if
an
I'm
actionable
yeah,
item.
getting them out of analysis
Yeah.
paralysis. You
Yeah.
don't want to do that.
Don't get into analysis paralysis. So actually what you said is right. If you don't have the relationships, you have to build those.
Yep.
This is a relationship business, just like any other area of real estate is. You have to build those relationships. There are tons of networking conferences, meetups. There's everything's like online now. You can
Yeah.
do virtual. There's a ton of YouTube videos, Instagram videos that you can watch, and you can really learn and understand the vocabulary. I like to tell people to spend time learning what cash on cash, IRR, AAR, equity multiple, know what those words mean so you can
Yeah.
speak intelligently about it.
Yeah.
Whether you're operating or acquiring or raising capital, you need to know what those definitions mean.
Okay, awesome. So Veena, I really appreciate, some of the insight today. And if you've had any realizations as you've been watching this video, please share those in the comment section below. If you're interested in investing in multifamily, in the link in the description below as well, you can check that out to invest in deals like this one that Pace and myself are invested in. So Veena, thank you again so much. And we'll see you guys in the next video.